I want to start by talking about basically some high-level lessons about the economics of transformative, I'll use this one, of transformative AI or economics of AGI, which are not exactly, but let's say close substitutes to each other. And I have split this into kind of three big themes, which I call the good, the bad, and the ugly. What do I mean by that? Well, there is the productivity and growth impact of AGI, transformative AI. That's the good. There is the labor market disruption and inequality aspect, which is the bad. And then there are the TAI risks and alignment. I unfortunately don't have very much to say on that, but I'm still including it, which is the ugly. But it also has some economic repercussions, as David has already mentioned to us. So let's first jump into the good, and so that we can end on a high point. I'll do some economics 101. You can forget about the equations, but maybe some of you have seen this in your undergraduate econ course. The way that we economists think about the economy is that we produce output Y by combining capital K and labor L through some sort of production function. And that production function operates at a certain level of technology, which we call A. And then we mix those two things together, use our technology, and we produce output. From that output, we take a part and invest it. We take a part and use it for government spending, and the rest is consumption, looking at the world economy. And then that consumption, and I guess that's the critical part, is supposed to deliver us some sort of utility, U of C. So the big question that I want to unpack in the next 20 minutes or so is how will AGI affect all of that? And David, this time here, this is inclusive of the questions, right? Okay, perfect. And what will all these effects depend on? So let's start with the good. What will the output effects of AGI depend on? Well, if we ask the most cited economist in the world, Daron Acemoglu, he published a paper last year on the simple macroeconomics of AI, in which he predicted that AI will affect growth by raising it by 0.007% a year. So he does not believe that this is going to be very transformative. He thinks AGI is BS, essentially. But that means that there is more work for us to be done. This guy is the closest thing to an economic superintelligence. If he doesn't pay attention to these questions, then I guess many of us have to. So I think to take this question seriously, we have to actually take a step back and look at a much longer arc of history to understand how transformative AGI will be for the economy. As David has already mentioned, in prior decades, or even for the past 2 centuries, everything in the economy revolved around capital and labor. But if we take a step even further back towards the Malthusian age, it wasn't always like that. During the Malthusian times, the most important factor of production, the most important thing to produce output in the economy was actually land. And then you needed human labor to work the land, but unfortunately the human labor was actually pretty dispensable. The way that economists put it is the marginal human had just enough to cover their subsistence needs, so what they ate and what they produced kind of was equal, and that means they did not produce any excess economic value. This is what Malthus described as essentially the Malthusian trap. During Malthusian times, during the Middle Ages and so on, human populations multiplied until they ran out of resources to sustain themselves. So everybody, or at least everybody except for like a few special kings and so on, had just enough to meet their basic necessities. Living standards were very low. utility, as we economists would characterize it, was not particularly high. And in some sense, from a material perspective, those were pretty bleak times. People were not doing particularly well. But yeah, since land was essentially the bottleneck factor of the economy, those who controlled the land were the most powerful, the lords. Well, then something really miraculous happened, the Industrial Revolution, driven probably by scientific advances, the age of enlightenment, and so on. And what happened during the Industrial Revolution is that we developed technologies to produce stuff so that land was no longer the primary bottleneck factor in the economy. Instead, we started to produce things with machines, and we combined those machines with labor, and that gave us the kind of productive structure that all of you who took Econ 101 saw in your undergraduate studies, where we combine capital and labor to produce output. This is just kind of given as like one of the most fundamental economic laws, although, as David points out, maybe it will soon no longer be that way. But yeah, the other thing that happened with the Industrial Revolution is that we suddenly started to advance technology in a sustained way. So technology started to progress at a rate of like 1.5%, 2%, and we constructed more and more machines, and the accumulation of better technologies and more capital allowed the economy to grow and to grow in a sustained way. But what was the bottleneck? The bottleneck was suddenly the human worker. Humans did not multiply at the same rate as technological progress advanced and as we accumulated capital. And that means humans became very scarce. And that scarcity of human labor is what drove the sustained advances in living standards over the past 2.5 centuries, and what made, in advanced countries, human living standards something like 20x what they were before the Industrial Revolution. So the fact that we were the bottleneck, the fact that we were scarce, that's what made us economically valuable, and that's what basically supported the standard of living that all of us are experiencing today in the economy. Well, now we may be about to enter the age of, let's call it AI or HEI. What's going to happen there? Technology is almost certainly going to accelerate. Capital, just like it was during the industrial age, can be reproduced, but labor is no longer bound to how many human bodies we have, but can also be simply reproduced by starting up another server farm, by building another robot. And those machines are going to compete with human labor. All the indications right now are that they are going to perform the kinds of jobs that humans can perform at what is currently a lower cost. And if a machine can perform your job, then competitive forces will ultimately drive your wage to the cost of the machine. So, yeah, what will this imply for output? Well, I have some simulation here in a paper that I published with the IMF 2 years ago. So the bottom line here is the baseline, how growth proceeded for the past, couple of decades. And then there are two HEI scenarios, which essentially assume that we automate the economy within 5 versus within 20 years. And the faster we automate everything, the faster growth takes off. And you see that this graph here covers only the left side of the screen. I'll show you the effects on wages when we talk about the labor market in the corresponding diagram that I will fill in on the right-hand side. All right, so back more conceptually to the output effects. These output effects, as we said, are going to be driven by technological progress, because I think all of us expect that AGI will allow us to make advances both scientific advances but also organizational advances more quickly than what we currently can in the human economy. They will be driven by automating labor, and I think it's important for us to, I visit this website every couple of weeks just to make sure I really read it correctly. The mission statement of, for example, OpenAI is to develop highly autonomous systems that outperform humans at most economically valuable work. Well, that means, yeah, if they really succeed at what they're saying, then labor is toast. But yeah, right now, sorry, I'm supposed to talk about the good, the output effects. So the good is if you relieve this bottleneck of humans, if you basically allow machines to perform all the valuable tasks in the economy, then you can grow the economy to a much bigger size. You can expand output, and you can basically move beyond that bottleneck. And that means growth rates that are currently unthinkable may be possible. One way of thinking about it, you know, you hear all these numbers. Is it going to be 20% or 50%? I have no idea. But one way of thinking about it is imagine you have, let's say, robots and server farms. How long is it going to take those robots and server farms together to double themselves? And that's going to give you a good kind of perspective on what reasonable estimates of growth rates will be. And yeah, the third factor that's also very important, we need this capital accumulation. So we need these additional machines, these additional robots and server farms in order to advance growth in the economy. Now, what may this, let's call it growth takeoff, look like, and what may it be driven by? In a paper that I'm about to put out with three co-authors, Tom Davidson, Basil Halperin, and Tom Holden, we look at how an intelligence explosion may trigger essentially a growth takeoff. And what I want to start with, I want to, oops, sorry. Here in this diagram, I want to, there's no, I guess, pointer. I want to focus on first just the right column here in the diagram. The right column shows you how economic growth proceeded during the industrial age. You had output being driven by advances in technology, or total factor productivity, as we call it technically in economics, and by the accumulation of capital. And total factor productivity kind of fed on itself, because if you have better technology, you can produce even further advances in the future. And capital, the capital stock rose because we used part of our output for investment and accumulate more of it. So this right column here captures what drove growth, or is driving growth during the industrial age. Now, what would happen, oh, thank you so much. What would happen if we do experience, first of all, AGI, and what are the potential dynamics for an intelligence explosion? So first of all, we would suddenly have all this AI labor that can perform tasks that previously were reserved for human labor. That means having all this additional labor will immediately allow our output to jump up. In addition, a lot of that labor can be dedicated to advancing technology, so to increasing total factor productivity. And now let's unpack what drives kind of the increase in AI labor. There are two forces. The first one is advancing software quality, and the second one is advancing hardware quality, and of course hardware accumulation. These two can again feed back on each other and can imply that essentially the available amount of AI labor is going to grow very rapidly and therefore drive these increases in productivity and increases in output. So that's essentially kind of an overview of how an AI takeoff may look from an economic perspective. Now, I want to add a little bit more texture and discuss a few factors that I think are important to keep in mind if we dig a little bit more into the weeds. So the first factor are bottlenecks. In some ways, you can say bottlenecks are kind of like the weakest link in the chain of expanding output. They are what's holding us back from producing more. If you need to, I guess the simplest story is like the O-ring story. If you need to follow 100 steps to produce something, but you can only automate 99 of them, and the 100th relies on some bottleneck, then you cannot produce more because that bottleneck is always going to hold you back. In practice, it's not going to be as stark. In practice, bottlenecks can be, to some extent, substituted for. So let's say if you don't have enough energy, you can focus on developing technologies that do the same thing with a little bit less energy, or things like that. So you can get around bottlenecks, but still, the more bottlenecks there are, and many of them we're probably not aware of yet, the more that will hold back economic growth. A second really important distinction that is oftentimes conflated in this debate is the distinction between cognitive and physical work. So for all those of you with aggressive timelines, your timelines are probably at first about cognitive advances, about the fact that AI may take off on the intelligence side, but that may or may not very quickly give rise to physical automation. And even if we have the physical automation, we also have to produce a lot of machines, a lot of robots, and so on, to take full advantage of that. So I will go back again to OpenAI's charter. They wrote I won't go back on the slides, but they wrote about basically automating the majority of economically valuable tasks. Now, the majority of economically valuable tasks is actually physical or involves at least some physical component. It's only, depending on how exactly you measure it, 10 to 20% of the economy that is purely cognitive. And I guess many of us are in that segment, and that's why we can feel it acutely, as you mentioned, David. But still, the majority of jobs has an important physical component. And if we only have the cognitive intelligence that's at human or superhuman levels, that doesn't mean that we should expect a dramatic growth takeoff. It only means that we can do these 10 or 20% of the economy much more efficiently. What that means is, if that happens, there's going to be so much economic value in automating the physical parts as well. So we should expect a lot of investment flowing into that. Then the third point I want to emphasize is you can think of kind of the long trajectory of economic development as progressively relieving bottlenecks. So you can say the Industrial Revolution relieved the bottleneck of land, but then introduced the bottleneck of labor. Now we may be on the verge of relieving the bottleneck of labor, and it's not quite clear what will hold back growth after that. It may be energy, it may be the availability of certain special rare earths, I don't know. None of them seems like the obvious predominant one, especially if we are really kind of close to fusion or things like that. Ultimately, and I guess I'm listening to people like Anders when I see something like that, ultimately maybe it's just going to be energy and matter within our event horizon, but this is kind of beyond my expertise. But it's a huge economic question because whatever is the bottleneck will be the most valuable. Now, I also want to kind of talk about some confusions that sometimes occur in the debate between economists and technologists. And one of the confusions is economists always like to talk about productivity, but technologists oftentimes talk about prices going down when we economists talk about productivity going up. And in some sense, that's actually just using different language for the same thing. So I remember, for example, Sam Altman wrote this blog post, Moore's Law for Everything, in which he suggested, oh, the prices of everything are going to halve every 2 years in accordance with Moore's Law. And we economists, we don't really measure things in dollar terms when we talk about, for example, GDP, but we measure them in real terms, adjusted for these price changes. So if you say prices go down by half every 2 years, I guess what you may be meaning is, well, we can produce the same dollar amount, but at half the price, which would correspond to, we can produce twice as much every 2 years, which would be a growth rate of like the square root of 2, 41% or something like that a year. And those two statements are economically kind of equivalent. So economists prefer talking about the growth rate adjusted for prices, and halving costs means essentially doubling productivity in that. And one of the reasons is because prices ultimately are a unit of account, and it doesn't really matter whether you say, for example, my economy is $1 trillion big or is 100 trillion yens big. It's the same, you just convert things. People in Japan are not wealthier because $1 is 100 yen or something like that, right? So these are just units of account, and we want to adjust for that to measure the real effects of economic growth. A second point, and maybe this is more like a very strong opinion on my side than a confusion, is about scarcity. So I think in part, you know, inspired by Star Trek and so on, a lot of people talk about a post-scarcity economy. And I suppose if they use that term to just say an economy that will be a lot wealthier, in which there will be a lot more abundance, then I'm okay with that. But technically, we economists, we call something scarce, we call a resource scarce whenever it has a non-zero price. So even if something is really cheap, it meets that definition. Now, if AI takes off in a good way and produces all this abundance for us, resources will still have non-zero prices. There will be a lot more of them, but they will still be valuable. And the relative value of different resources is going to be reflected in their relative prices. So I think it makes more sense to talk about material abundance than about post-scarcity. And one thought experiment that's highly useful in this context, imagine we were having this conversation in 1800, and we're going to talk about a post-Malthusian economy. Because some people are very foresightful and are seeing kind of the writings of the Industrial Revolution on the wall. Imagine you told people, okay, every one of you is going to be 20 times wealthier in 200 years from now. People say, well, that's unbelievable, it's inconceivable. So in some sense, you could say, we almost already live in this post-scarcity economy compared to the conceptions that people had in 1800. But for a lot of people, it doesn't quite feel like post-scarcity. Prices are still positive, and what matters are their incomes relative to their prices. Okay, so that brings me to the bad, the potential labor market disruptions and inequality effects. Again, what will drive these? What will they depend on? And here, I won't start by citing Daron Acemoglu, but I will put up an interview by Dario Amodei that he gave with Axios a couple of months ago, in which he warned that AI could wipe out half of all entry-level white-collar jobs and spike unemployment to 10 to 20% in the next, well, there's a wide confidence interval, 1 to 5 years. So this is, I guess, what an industry insider describes as the potential labor market effects. But let me perhaps again look at what are the economic channels that would drive this disruption. So the first one of them would again, the first, and I should say that drive the effects on the labor market, because some of these effects are positive, right? The first one is just technological progress, which kind of has a tendency of lifting all boats, of making everybody more productive. If I just give you, I don't know, ChatGPT or Claude or Gemini, you are more productive as a worker, and that makes your labor more valuable. The second one, but that's now the hugely disruptive one, is the automation of labor. Again, if a machine can do a worker's job, the worker's wage will tend towards the machine's cost. And the third one, and this is again positive, is capital accumulation. If I give you better machines to work with, then your labor actually becomes positive, but becomes more valuable. So what this tells us, there's three main channels. Two of them are actually positive, but one of them is negative. And ultimately, there is a horse race going on between the positive and negative effects. In the short term, it is plausible that a lot of workers are going to benefit from the positive effects. But then if we reach the full AGI as in this definition here, then I think it is very likely that the negative effects are going to predominate. Again, I want to add a little bit more texture. Right now, we are talking about more like task displacement than job displacement. So right now, there are very, very few jobs that can be wholly done by AI. And a lot of the economic work in this area is on which tasks can be replaced, not which jobs can be replaced. A second point I want to emphasize is that when you read like the newspaper, you oftentimes hear about what will be the jobs impact of AI. But what is actually the more interesting and more useful question from an economic perspective is what will be the effects on labor demand. And the reason why I say that's more useful is that we think of the labor market as kind of an equilibrium that is driven by both demand and supply. And what usually happens, and what has been happening for the past 200 years, is the supply of labor has been pretty much fixed. Essentially, every working age adult nowadays, or the vast majority who are not busy for family reasons, are supplying their labor to the labor market. That means supply is pretty much inelastic, is the term that we use. So supply is fixed, but labor demand is what fluctuates when technology fluctuates. So if you reduce labor demand, but you have a fixed supply, what happens in equilibrium is that it's the wages that actually bear the brunt of adjustment. So in the very short term, there's some job displacement, but as the economy re-equilibrates, wages go down. The total number of jobs is not materially different from before the shock, but you can see that wages are at a lower level when you have a negative labor market shock. And that means focusing just on the job numbers, that may be a useful short-term guide, but talking about like medium to longer term developments, we have to focus on wages, not just jobs. And that's captured by essentially the relationship that we call the demand curve, which captures at which wage will employers hire how many workers. Let me show you a simulation from a paper on scenarios for the transition to AGI, in which we trace out how the fraction of automated tasks will affect both the wage bill and the returns to capital. What you can see here is if you automate and if capital and labor are complements, at first labor becomes more and more and more valuable because it makes the economy more productive to use machines for tasks that previously required very scarce labor. And that means at first almost all of the benefits go to labor, but then after a specific threshold, here now a simulation is like 80% automation, all of a sudden the kind of abundance of capital and the fact that we need workers only for very few remaining jobs implies that wages plummet and that all the returns suddenly go to capital. So this is one specific simulation under specific parameter values, but I want to put it up to just show the possibility that as we automate for a long time, we'll see positive effects on labor, and then they may suddenly flip. And now I'll show you the counterpart to the output effects of growth on the wage front. So if we have, the baseline was that wages and output kind of grow in tandem, but if we have AGI in 20 years or 5 years, then you can see that wages at first rise faster and then they plummet. I'm actually running a little bit short on time, so I will race through a few slices. If labor is devalued, the big question is where does the value go? Because the value doesn't disappear. If we can do something more cheaply, let's say using an AI that costs 1/100th of the cost of a worker right now, that means the economy is still producing the same thing and the value goes, depending on how the economy is arranged, either to workers or capitalists, or a lot of it, frankly, just goes to consumers, which is actually good. But it also kind of highlights the importance of distributive policies, and that's where I want to go next. So managing the transition is going to be particularly hard. There will be big winners and big losers on the road to AGI. The big winners never want to share what they won. The big losers always want to be compensated and don't want to lose. There will be an important role for steering technological progress, maybe also a role for slowing down progress, because having so many winners and losers is hugely disruptive. And there's many longer-term policies that are being discussed, UBI, UBK, job guarantees, compute slices. Right now, in the economic policy debate, they all seem outlandish. Nobody's taking these seriously, except on the fringes of the political spectrum, which is too bad if we are expecting these disruptions to happen very quickly. And of course, and many of you are going to talk through that for the rest of the workshop, there's also very important non-economic forces, like what does this all mean for meaning, for control, for agency, and so on. In a recent paper, I look at how will our tax system have to adjust under AGI. So right now, you can say that in the current economy, taxes on labor, tau L, I call it here, are the primary way of raising revenue. But if labor suddenly becomes devalued, our government is not going to have a lot of financial resources. So it means in the post-labor economy, we have to switch at first to the taxation of consumption, tau C, and then ultimately the taxation of the capital accumulation of AI itself. I will jump over this and this. There will be some roles left for labor in the post-AGI economy, some of them transitional, some of them for fundamental human-centric purposes, but is, from my perspective, unlikely that the importance and the share of labor in economic value overall will be anywhere near where it is right now. Again, I want to kind of clear up some confusions in the debate. First of all, I want to emphasize there is no economic law that would imply that new technologies always create jobs. In fact, it's just the law of demand and supply that as long as people are willing to supply their labor at any price, then the market is going to hire them, and sometimes the price needs to go down to clear the market. And sometimes the price goes down a lot as people, for example, during the disruptions of industries in the Midwest experienced in the past few decades. Prices oftentimes have to go down, but there is no fundamental law that labor always plays some sacrosanct role in the economy. It was just an empirical regularity for the past 200 years. And the second really important point I want to emphasize is, so even if the price of everything declines, or let's say some other form of what Sam Altman predicted in Moore's law for everything, what ultimately matters for workers is how fast the price of their consumption goods declines compared to their wages. And there are a lot of reasons to expect that wages are going to go down faster than energy prices. And a lot of the things that we consume to keep ourselves alive, like food, requires a lot of energy. So I think even if you have a strong belief that everything will become cheaper, labor is going to get cheaper even faster. Okay, now last point, I'll use just one more minute. The ugly, the risks of AGI and alignment. First, I want to observe that there are a number of really important economic aspects to alignment. People need material resources to survive. We may be able to do things more efficiently and so on, but we need some sort of income. Something else that's inherent in human preferences, people don't like uncertainty, certainly not really big uncertainty. People don't like big inequality. People don't like excessively rapid change, in part because it entails a lot of uncertainty. So I think we need to consider all these factors when we want to align AI to human values, because these basic economic preferences are part of our human values. And then ultimately, the main economic challenge in this debate is some sort of, to put it kind of in the brute and cold-blooded economic fashion, trading off the expected costs of disaster versus the expected benefits that AGI may deliver, both in terms of abundance and in terms of things like longer lives. So in some sense, you can see that lives are both on the left-hand side and on the right-hand side of this trade-off. If the AGI kills us, that's a cost, but if it makes us all live for hundreds of years, that's also a benefit in terms of lives, not just in terms of pure abundance. But I think the central part is there are vast externalities in who makes these trade-offs. Right now, it is a handful of executives in a handful of very powerful organizations that are making the decision on behalf of all of humanity. And their decisions entail vast externalities, vastly asymmetric payoffs, like if they succeed, they will pocket a huge amount of the benefits. If they lose, all of us are going to pay the costs. It's kind of the classical definition of an externality. And I don't think that's good. So again, let me clear up a confusion that you sometimes hear in this debate. Does the economy need humans? Like, does it need human demand? No, for the economy, it is perfectly possible to have an economy that's driven only by the machines, to kind of paraphrase Lincoln, to have an economy of the machines, by the machines, and for the machines. And we don't need to be there for the economy to function. But, sorry, David, you said we should not impose values. But I do think that's not what we want. Thank you.